We have a bunch of Fed programs that have been aiming to help companies and sort of maybe do your job for you in some ways. But the default rate now is something like 4.5%. And as you said, we're at the highs, in the most recent sort of cycle. What happens next? Do we get another leg lower? Do we get, more fallen angels? Do we get a whole bunch more distress?
Yeah, it's a really good point. I mean, when we spoke last, the high yield market was yielding 12%. Today it yields 6%. So it's come ripping back. You've had record buying for high yield bonds with $50 billion of inflows coming into what's recorded markets like mutual funds and ETFs and others. It's been record inflows. And so with that, the markets feel a lot better. But below that market and below the surface are these undercurrents that you're talking about. And so although the markets are somewhat healed now, Vonnie, the real economy's not, and a lot of these companies are not. And there's a lot of problems brewing. And so what do we expect with default rates? Well, we've recorded at Marathon since the beginning of COVID, since mid-March, we've recorded 60 bankruptcies here in the United States, totaling about 100 billion. And we think that 100 billion number will grow to 400 billion. That is, the 4.5% default rate will grow to 18% cumulative, which takes you to an annual default rate of about 10. So default rates, as you know, is measured in trailing 12 months. And so we'll go from 4.5% to 10, but before this is all over, there'll be a cumulative rate, which is 4 times the 4.5% that we've already seen, 18%, taking you to 400 billion. As it relates to, downgrades, the downgrades are coming, they're coming ferociously. We have 20 downgrades. It's actually close to 30 downgrades for every upgrade by Moody's and S&P's, the credit rating agencies. And so that 20-30 to 1 ratio is so much greater than we saw in the great financial crisis when the ratio was more like 10 to 1. In terms of fallen angels, you mentioned that. There's been about 200 billion, not quite, about 185 billion thus far. Investment grade that's fallen too high yield, we think that number grows to 400 billion as this plays out over the next year and a half, because what's really ailing these companies are revenues and EBITDA, despite the Fed injecting all this liquidity and market rushing into both the equity markets and the credit markets. And markets should improve because that liquidity gap has been healed in a very big way. I mean, the U.S. is a $21 trillion GDP, and the Fed has added $3 trillion to its balance sheet, and in fiscal spend, that's also been about $3 trillion. So it's $6 trillion on a $21 trillion GDP. If you think about it that way, that's 28%.
Just on the bankruptcies for a second, Bruce, that $400 billion, will that be the liabilities on the balance sheets, or what will that $400 billion be? Because sometimes it's hard to actually tell.
Total debt outstanding of these companies that file for bankruptcy in aggregate, we think it's to 400 billion. It's currently 100 billion. So we think it's a fourfold increase from here.